this week, in a very surprising turn of events, we saw there was a release. I don't know whether to call it a release, a research note, basically, by AIB-AXYS Africa.
Access.
Oh, it's pronounced Axis.
That's what I call it.
Oh, AIB-AXYS. Okay, that makes more sense.
Yeah.
I've never known how to pronounce it. But yeah, AIB-AXYS gave a recommendation on Kenya's biggest and best taxpayer, Safaricom. So, and the recommendation, lo and behold, very surprising. They actually gave us a sell recommendation on Safaricom, which I was very surprised to see. So for them, they're saying that their main argument is that the market overreacted to the news of expansion into Ethiopia.
Yes.
So they believe that the price should be 38.1 instead of the current 42 shillings.
Do you know my interpretation of this, of what they said?
Yeah.
It was that currently it's at 42, don't sell, but should it go down to 38.81 shillings, at that point now you should sell.
Why are you changing what they're saying?
I said not my interpretation.
Yeah, they do not say don't sell. They said sell. As in, you're going back to the days of high school. What was the persona of the poem?
No, you see, the
poet said the glass is blue. That is what he meant. It did not mean that he's going through a dark time within himself. So for this one,
it's English for that one reason. Poetry?
Clearly, they put it in bold and capital letter.
Yeah.
Sell.
So okay, this is the wording. Huh? We issue a sell recommendation on Safaricom Public Limited Company with a target price of Kenya shillings 38.81, representing a downside of 7.6% on the current price of Kenya shillings 42.
They say because the price is high, sell. Because what essentially they're saying is this price is not going to go higher than 42.
But it was at some point it was 40. It got to 45.
Yeah, it was at 2 bob. At that time when it was at 2 bob, guys were like, if it gets to 5 bob, like please, if it gets to IPO prices, as soon as it gets to 5 bob, sell.
Yeah.
And for me, I do not agree with them. I strongly disagree. If it was possible, I would have violently disagreed.
Yes. I agree with you.
Because again, then you go ahead and you say that the company's fundamentals remain strong.
I'm like, why are you giving conflict?
Yeah, if a company's fundamentals remain strong, then why?
It's a buy.
Yeah, why should you sell and say because over 7% reduction? And then if you're going to go technical on their valuation,
let's go technical.
If you're going to go technical on their valuation, and this is a report they just issued on the 27th of October. So they used a discounted cash flow method to value. So we're going to go a bit.
Okay, if you use discounted cash flow, then it makes sense.
It makes sense, but
because their cash flows are bound to bleed in the like the short in the near future because of the cost implications of the expansion into Ethiopia.
Maybe, but the thing is, even I don't want to get into like being I'm not a prophet. I'm not I do not have a crystal ball.
Okay.
But the thing with the discounted cash flow is it relies heavily on forecasted
models,
making forecasts, and we do not know exactly how it would work. And even for them, assuming that their forecasts are okay,
but you see, we're already seeing problems because one of the financials of the IUS financial of this expansion into Ethiopia, they're already delaying with the funds.
Yeah.
So what are you to expect about their cash flows into the future, especially when they're getting into Ethiopia now? Because that is a very capital intensive project. And if the people who had pledged to finance you are starting to delay as early as now, you're bound to really struggle. And so if the model you're using is this year for the discounted cash flow model, then it makes sense to say that it is overpriced.
No. For them, I think for AIB-AXYS, they have factored in those expectations in their modeling.
Okay, we hope.
I want to assume.
Yeah.
For me, I'm just going on the assumptions, because the assumptions is what kills or makes your forecast. So in this case, when you're looking at their cost of equity assumptions, which is towards the end of the report, page 13. So they do have the risk-free rate of 12.3%, which I believe is based on the Treasury Treasury bond rate. Country risk premium of 5%. Maybe we can I'm not sure what justified the 5%, but that's fine. Company beta of 1, okay, because they're saying essentially Safaricom is the market. Safaricom would.
It controls over 60% of the market.
That's okay. Cost of equity, that brings to a cost of equity of 17.3.
Why?
So this formula, it's called CAPM.
Okay.
Capital asset pricing model. So the capital asset pricing model is your. So the formula is usually you have your risk-free rate.
Yes.
In this case, it's the 12.3%. Then you add. So there are two. It's essentially your risk-free rate plus the equity risk premium. So the risk-free rate is given by the 12% given by the Treasury bill bond. Then you add
the equity rate.
So the formula is RF, which is risk-free rate. I wish
you should have given a disclaimer.
But you're
going to get geeky,
I did give a disclaimer.
Okay.
So it's the risk-free rate plus beta into the market return or market rate minus the risk-free rate, which is now considered the equity risk premium.
Okay.
So multiplied by beta.
Okay.
So when you multiply,
what is beta?
Beta is the sensitivity of a stock to changes in market movements.
Okay.
So that's why when I was saying they do have a company beta of 1, it means that Safaricom prices essentially move the same with the market.
Okay.
Like it's very best way to say it's very correlated with the market.
It's sort of like the determinant, one of the determining factors of how the market will perform.
How the market moves and how Facebook moves. Like it's very close.
Safaricom.
So sorry, I said Facebook.
Yes.
I don't know how. How Safaricom moves.
Shareholder.
Virtual. So if you have a high beta, it means your stock movement is more volatile compared to the market.
What is a high beta?
A beta higher than 1.
Okay.
So a beta higher than 1, and the higher it goes, it means that stock is very volatile. It moves compared to how the market is moving. It moves it varies quite widely, to say the least. Then if it's a beta of less than 0, less than 1, then it means it does not move. It's very stable.
Stickiness.
So something like Kengen, I assume, would be very stable, and
because it's not the fundamentals are very detached from what is going on in the market.
So it tends to be it just stays around the same. It doesn't move around a lot. So for company beta of 1, it means that it's essentially moving the same as the market. If the market has high times, it moves high with the market, and which makes sense because Safaricom influences 60% of
the market. Telecommunications.
Yes. So then this brought cost of equity of 17.3 because essentially it's 12.3 plus the equity risk premium 5 multiplied by 1. So when you add the two, 17.3, we can say that's okay. So my issue with them is their after tax cost of debt.
Okay.
So their after tax cost of debt is 12%. So to get your after tax cost of debt, it's usually your debt rate. Yeah, like what you're being charged for debt. If it's 12%, 10%, so it's your debt multiplied by 1 minus the tax rate.
Okay.
Yeah.
Okay.
So in this
talking corporate tax or
corporate tax, because that's the tax that essentially it should be your effective tax rate. So but usually for simplification, they usually use corporate tax.
Okay.
So in this case, if your after tax cost of debt, they've put their after tax cost of debt as at 12%. That means that your actual cost of debt is 17%. You have to work backwards.
That is 12. Then you've added
so because essentially that 12
the risk premium.
No, not the risk. The after tax cost of debt. So after tax cost of debt is equals to debt multiplied by, in brackets, 1 minus 30%.
Okay.
So if you are to get the
0.7,
debt,
then
so 0.7. So essentially it's supposed to be 12% divided by 0.7 to get your actual cost of debt. Yeah. So when you do that, it's coming to
17.
Yeah, it's coming to like 17%.
16.98. So, 17.
Yeah. You want to tell me Safaricom are getting debt at 17%?
No, cannot
it
be.
Does not make sense.
Does not
That,
make sense.
So I went ahead and tried to look at Safaricom's latest annual report. But they did not disclose
the interest expense.
No, they did not disclose the interest rate that they're being charged on their different borrowings.
But you can have like a feel, sort of.
Yeah.
If the outstanding debt is $1 million, Bob, then you see the
interest expense.
Interest expense is like 70K.
Yeah.
Then you can have an idea.
Yeah, actually.
Maybe you can do that later.
Yeah, but I don't think
it can't be
17%.
You'd rather issue a corporate paper.
Yeah, like guys are getting bonds at 12% for Safaricom, which is how big it is, how liquid it is, because it's heavily everything you pay cash.
Yeah.
I don't see a world where they are having.
So AIB-AXYS, you're actually discrediting your.
So like this after tax question debt. Yeah, it's their question. We are questioning. Maybe they explain to us.
Yeah.
Where they got the 12% as an after tax cost of debt.
Yes.
Because that now that directly affects your discount factor.
Yes.
In the DCF.
Yes. A lot.
Yeah.
With a difference of over. Okay, we should work with 12%. That would be fair.
Yeah, it should be 12% debt. So
that's 17.
That's 17.2.
A 5% difference. That's a lot.
That's a lot.
That's a lot. That's a lot.
So then when they do, so you see, because this is highly, so their weighted average cost of capital then gets
inflated.
Yeah, boosted upwards. It means that when you do the DCF, you're going to get a lower intrinsic value than what it should be. So
even with that,
they're just even with that without going deeper into their assumptions and this forecast here and there. In that case, it's this cost of debt, because again, even for the weighted average cost of capital, which we can get that from their books, basically, like the portion of debt to equity, to get the correct weighted average cost of capital. But the fact that they've used such a high cost of debt, for me, puts question marks on their recommendation.
To show how good or stable or how good a company Safaricom is, even with such a big difference, mistake sort of in the weighted average cost of capital rate. In this model, what they're foreseeing is just 7.6% correction.
Yeah.
Come on, this company is a very good company.
Yeah, and then also how they got to, because from the valuation, now the DCF came to a price of 33, which they gave it a weighting of 80%, and then when they use the price to book valuation approach, it has a price of 73. Then price earnings valuation approach. It has a fair value estimation of 46. But these two other approaches, they give them weightings of 10%, 10%.
Yeah. But you see, I think what the market looks at more is the price earnings ratio.
Yeah, price earnings that's for me as an investor. Yeah. That's what I would want to look at.
And it's the investors who determine the prevailing stock price. Huh?
Yeah.
So essentially, let's work with 45. They've said it's 46, but let's work with 45.
Yeah.
So again, using that, I would issue a buy recommendation for Safaricom.
Yeah,
confidently.
For this one, like, there's the questions on the assumptions on DCF.
Yeah. You might get someone fired. So.
No, but this was approved by how many people?
Before
it goes out to the market, like, it's gone through many eyes.
That's anyway.
So that's the question, and consistently, like, their earnings have been growing year on year. Safaricom's earnings have been growing year on year. Like, it keeps growing. So I do not see.
Plus, look at what happened even with COVID, and after taking after reducing the revenues intentionally by cutting the
M-Pesa transaction costs. Yeah,
company still survived.
And did well.
It
prospered, not survived.
Come on. So how dare you, in a recovering economy, give such come on.
Yeah.
AIB-AXYS.
And even when you go to at the end of their page, the last page basically.
Yeah.
We
should give this report on one of our socials. So what?
Yeah, so that guys can have a look at it and
follow through.
Yeah, because even for them, they say they issue buy recommendations on counters with strong fundamental, whose upside lies above 15%. Hold issued on counters with an upside of between 5 and 14.9%, with limited avenues for growth. Sell, the counter currently has weak fundamentals coupled with potential downside. But Safaricom does not have.
This is contrasting.
Yeah, it's very controversial. Yeah, they do not have weak fundamentals. And while the potential downside is because of the volatility in the market, like long term, Safaricom has growth opportunities. We've seen with the expansion into Ethiopia, like there's a whole, like almost a blue ocean, like there's many possibilities there. And then,
but remember, the company beta still won.
Yeah,
and they agreed.
So, yeah, for me, that's my opinion. That's I feel like I would have the question on the assumptions, the underlying assumptions on their weighted average cost of capital and how they came about with, especially that cost of debt.
Rates,
and then because you are relying a lot of assumptions and forecasting into the future, to issue a sell recommendation on a stock that is doing very well, that has been growing year on year in terms of earnings, in terms of its influence in the market, that is consistently paying dividends, I don't agree with that recommendation.
We will give this company, AIB-AXYS, what is it called?
Right of response.
Yes.
Yeah.
Yes.
If they're interested, like if they would want to respond, but that's our view.
They should.